Hello, everybody. Welcome to our first chapter on our first day in our introduction to accounting. Um, the first thing we're going to talk about is accounting for businesses. We have some special rules that we have to follow when we're working with businesses versus doing our personal books. Back on track. I'm going to try not to wax on for too long. But this is one of my absolute favorite topics, how important accounting is in our business world. Okay. I know that a lot of you are not going to be accountants by trade, right? Some of you are saying to yourselves, well, I'm going to be the CEO of my own company and I'm going to have people for that. But at the end of the day, you are the person whose name goes on your financial statements. You are the one who's responsible for those financial statements. So, whatever your managerial role is, it is important that you understand what those documents are telling you, even if somebody else is doing them. Okay? Those the accounts are where you identify all the financial events that happen in your company. Okay. This is how you're going to measure your success or failure. Okay. Um, this is how you're going to communicate that success or failure to the owners of the company, to the shareholders, if you will. Okay. Um, and just for the purposes of making sure that we're all on the same page, be sure to know the Webster's definition of accounting. Okay. This is an information and measurement system that identifies records and communicates an organization's business activities. Okay. Um, now, depending on who your audience is, you will provide it in different formats. Okay. So generally, we split those two groups of people into external users and internal users. Okay. The external users are those people who are outside of the company. Okay. So those are your shareholders, people who want to lend you money, your external auditors. Okay. Um, and the government. Okay, those who are creating the regulations that you have to follow. All right, your internal users are your purchasing managers, your human resource managers, research and development managers, and any other people that you can think of with the word manager after their name. Okay, people from within the company who are responsible for making financial decisions. All right. Um, Accounting is an area of a lot that is experiencing a lot of growth right now. I know there's some trepidation for some people because of the emergence of AI, right? But this is just another tool in our arsenal. The decision making, the logic, the rationality that comes from your higher level accountants. Okay. The bookkeeping roles, the spreadsheet um, preparation, things like that, those little tedious tasks are the ones that AI is soon to be taking over. Okay, but our jobs are secure. Um, some areas of accounting that may or may not interest you. There's financial accounting. That's primarily what we're going to be talking about in this class. This is where we are going to prepare the financial statements For companies, also, auditing falls under this category. This is where we review a company's financial statements to make sure that they're fairly stated. Okay, we have managerial accounting. We have a whole course about that here at ECPI. It's the 312. That is the accounting that centers around budgeting and decision making within your company. Of course, we have tax. That's what most people think of when they think of accountants. Um, Tax preparation, of course, but also planning and regulatory functions, investigations. Forensic accounting and fraud examination is also a hot ticket item, especially if you are very tech savvy. Okay. And then there's the day-to-day number crunching accounting. This is where you have your day traders, your analysts. They put forensic accounting under this umbrella. I feel like it goes more with auditing or taxation, but um, system designers, market researchers, all of those guys. Accounting is a huge field and it goes well beyond tax. I wish we had more time to spend on each one of these areas because there really are some fascinating things happening in accounting, especially because of emerging AI technology. Anyway, I'll stop gushing and move on. All right. So, one of our benchmarks of accounting is our ethics. Okay, we need to provide useful information to our shareholders so that they can make informed decisions. Okay, in order for that information to be useful, it has to be trusted information. Okay, so accounting is very concerned about ethics. I have to take an ethics refresher every year as part of maintaining my license. There are many, many rules and regulations regarding accounting ethics. We will not dive into all of them in this course, but it's important to know that as accountants, you must always conduct yourself in an ethical way. Okay. Um, so just an intro to forensic accounting or, fraud investigation. Generally, when we see fraud occur, it is because one of these three legs of the fraud triangle is present. Okay. Opportunity. This is why we have internal controls over our accounting. Okay. If there are no controls, no security over our financial assets, we create this opportunity where theft can occur. Okay. Rationalization. This is when someone within your company doesn't see what they're doing as fraud or as a criminal act. Okay. This might be because you don't have proper training in ethical behavior, or it could be because the tone at the top, the image that you're presenting for your company makes it seem like being a little bit shady is okay, right? And then that leads me into pressure. So, when we tie our manager's livelihood too closely with financial performance, we pressure them sometimes to maybe fudge a little on their numbers in order to keep their jobs. Okay. So let's not put that pressure to be a bad actor onto our managers in our company. Okay. As accountants in the business world, we are governed by the generally accepted accounting principles. We refer to that as GAAP. Okay. We the underlying theme of GAAP is that information should be relevant and faithful. Okay. Um, so you only want to include that information that is relevant to your decision makers. Let's not, baffle them with a lot of BS. Okay. Just the facts. All right. And then we want our information to be as accurate as possible. Okay. We don't have a crystal ball. We do sometimes have to deal with estimates on future performance. Okay. That is allowed. All right. But we want all of our data to be as faithful as possible. Okay. So we have the Financial Accounting Standards Board. We call them FASB. FASB sets our GAAP rules. Okay. They derive their authority from the Securities and Exchange Commission. And the SEC also oversees GAAP. Okay. But they oversee a specific area, which is those companies that are publicly traded. Okay. So if you sell your stocks freely on the any type of stock exchange, you are following SEC guidelines for that. Okay. And this slide always makes me laugh. Okay. So we have international standards and an International Accounting Standards Board, IASB. Okay. They set our international financial reporting standards, also called IFRS. They This is the sort of generalized international standards, but they do differ from GAAP standards in some ways. So we can't follow IFRS in this country for our financial statements that are published in this country. So if you're a multinational, you might have to create multiple sets of financial statements in order to meet all of the different regulations. Now, this is why I laugh, because back when I was in school, when dinosaurs roamed the earth, they told us that, FASB and IASB are working to reduce the differences between the international standards and GAAP. And at that time, they told us they were within 2 to 3 years of merging those two systems so that everyone had a universal standard that we would all follow. Well, that was many, many, many years ago. I won't say how many, but it was definitely more than 3. Okay. So I don't know that that will ever happen, but if it does, I will throw a party. All right. So, we also have this conceptual accounting framework. Okay. So, at the base of our pyramid, we need recognition and measurement. This is when we recognize a financial transaction and we measure it. So, we know that we're selling an item and we're receiving cash. So we know that we need to make a financial record of that, and we need to know what amounts were involved. Okay. Now at our next level, okay, we need to have some qualitative characteristics. Okay. And we need to know what elements we're going to use to describe these financial transactions. So we received cash. Okay. Cash is an asset. It's something that we own. Um, that helps us to run our business. So now we have categorized that item and we know where it goes in our accounts and where it will appear in our financial statements. Okay. Um, and this rolls up into our objectives, which is to provide useful information to our investors, our creditors, and regulatory agencies and the public. Okay, so we have these general principles. Okay, these are assumptions that we have to follow when we're preparing our financial statements. More on those later. Okay. And then we have our specific principles. Those are our detailed rules that we have to follow when we are reporting financial information. Remember, we talked 2 slides ago about all those agencies that govern our financial statements, right? They write the rules of the road that we're going to have to follow. All right, so our accounting principles. All right, this sometimes some of our transactions that we do might seem a little counterintuitive. Okay, and the way that we measure things in accounting are based on these principles. All right, so first, our measurement principle. All right, all our accounting information is based on actual cost. Okay. And that cost is objective. All right. We have our revenue recognition principle. This means, and this is the golden rule of GAAP accounting. Okay. You have to recognize revenue when the goods or services are provided to the customer, not when you receive cash, but when you provide that good or service. Okay. And you have to record that revenue at an amount that you expect to receive from the customer. Okay. The opposite is also true with expense recognition. Okay. The company records expenses when they are incurred. Okay. So it's the opposite, right? Revenue when we provide the service, expense when that expense is incurred. Okay. Um, the reason why we do this is we want to link that expense with the revenue that it's helping to generate. Okay. And that's the matching principle. Okay. So some assumptions that our financial statements are based on. Okay. The going concern assumption. That is the assumption that this business is still going to be in operation during the next accounting period. Okay. This is not our liquidation period. All right. Um, the monetary unit assumption. This means that all those numbers that we put in our ledger and in our financial statements, those are expressed in monetary units. Okay. In this country specifically, we're using US dollars. Okay. The time period assumption. Okay. We're assuming that we can break up the life of this company into discrete time periods. Okay. Maybe a year. If you are a publicly traded company, you have to issue financial statements at least annually. Many companies produce financial statements quarterly. Okay. Those are discrete time periods. And then the business entity assumption. Okay. That means that this business is its own separate entity and its accounting is separate from any other business entities, including the owner. Okay. You are not permitted to commingle your financial transactions with the company's financial transactions. Okay, that is it for this slide deck. I will see all of you in the next one.